Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today we're going to be starting on investing fresh. So fresh, in fact, that I have shaved my face and I feel like I look about 5 years younger than I did yesterday. And we're doing this video because of a comment from someone called Deborah Barnes. So thank you, Deborah, for commenting this. Basically, Deborah just wanted to go right back to the fundamentals of some of the basic terminology of investing. So what is the stock market? What's a stock? What's a bond? What's a dividend? All that sort of thing. So that's what we're going to be talking about today. If you've been investing for several years, this may not be of any use to you, or it may just be a nice refresher. If you're new to investing, hopefully you can learn something out of this video. So hope you enjoy it. If you do have questions or suggestions on future videos, definitely drop them down in the comments below. Comment anyway for the algorithm, as Graham Stephan might say. So hit like, hit subscribe. Hope you enjoy the video. Without further ado, let's get into it. Alright, so let's start from the very basics of some of this stuff. Like I say, we're going to be talking stocks, shares, bonds, dividends, all these different things. There's a lot of different complicated terminology out there, so I'm going to try and keep it as basic as possible. So let's start from the beginning. So the first thing we're going to talk about is what is the stock market or the share market. You hear both of those different terms thrown around quite a lot. They are the same thing. So often it's called the stock market in the States and the share market in places like New Zealand and Australia. I watch a lot of American stuff, so I just tend to say the stock market regardless. They are the same thing. So you don't have to, there's no difference between share market, stock market. It's just called different things in different countries. And essentially, the stock market or share market is a place where ownership of companies is exchanged. So you can buy and sell pieces of ownership called shares on a public market. So a lot of companies, a lot of very large companies out there in the world, Apple, Facebook, the A2 Milk Company or Fonterra here in New Zealand, they are what's called publicly traded companies, which means they aren't owned by a handful of private individuals or anything like that. Ownership in those companies is able to be bought and sold by anyone. So all you need to do is have an account with your bank or whichever broker that you want to trade with. And I've got a video on brokers, so I'll link that up the top here as well if you want some information on that. But basically, public companies, they trade on a stock market or a share market or a stock exchange. All of those things basically mean the same thing. And you can buy and sell shares, which are small pieces of ownership in those companies. So with shares and the share market, basically you can make money or lose money. Nothing's guaranteed out there. In essentially two ways. There are other more complicated ways that you can do things, but fundamentally there's two main ways that you could make money from shares. And it's the exact same way that you could make money from owning any other business. That's essentially all you're doing when you buy shares, is you're owning a small fraction of a business. So a business like Apple is worth something like $1.4 trillion. If you ever look up Apple shares or Apple stock, you can literally just Google that. You'll see something called the market cap. And basically the market cap is the total value of all of the shares added together. So it's what the market or public investors, public market investors are valuing the overall business of Apple at. So at the moment that's about $1.4 trillion. That's cut up into literally millions and millions of little slices called shares, and you can buy one of those shares for right around $300 or so with Apple at the moment. So that is all a share is. It's a piece of the pie, a piece of the pizza, a small slither of ownership in that company. And like I say, there are two main ways that you can make money from owning shares, and they are the exact same as owning a private business like a laundromat or your own business that you might own. So those two ways are basically capital appreciation, so the business can become more valuable over time. Typically that happens because a company becomes more profitable over time. They simply make more money, and as a result that business becomes more valuable. So if you buy shares at say $100, and let's say the market cap of that company is $1 billion, so you've bought a small slice of that large billion-dollar company. Let's say that billion-dollar company grows by 50% over a handful of years and now has a market cap of $1.5 billion. Your shares are going to have also grown by that same amount. So you're going to benefit from the company getting larger, becoming more valuable, and you can then go ahead and sell those shares for a profit because the business that you have a small ownership stake in has gotten bigger, has gotten more valuable, and you can profit from that. So that's the first way that you can make money from shares. The second way is through something called a dividend. So a dividend is literally a cash payment from a company to their owners. So just like you might do in a private business, whether that's like I say, a laundromat that you own, or whether you own a farm or a rental property, any kind of business that produces good cash flow, a company is no different. So with those businesses, like I say, whether it's a farm or whatever it is, you can do a couple of different things with the money that that farm makes. So you can go out and purchase more land, you can go and pay down debt, or you can simply keep that money for yourself if you're the owner of that farm and use it personally, pay it out to yourself. And that's basically what a dividend is. And a lot of companies have this exact same thought process. So if they've got opportunities to take those profits and grow the business, they might do that. A common example would be something like Facebook. They made profits, and they're actually a company that has never paid a dividend. They've never returned cash to their shareholders. Instead, they have chosen to reinvest within their business, and they've done things like buy Instagram several years ago for $1 billion, and that has made the company more profitable and more valuable as a whole. So there's pros and cons to companies retaining those earnings and doing things with it, or paying it out to you. But essentially, any payment out to you is called a dividend. So a lot of companies will pay dividends if they are a larger company that doesn't have as many opportunities to grow and acquire new assets and do different things. If they're simply making a lot of cash and they don't really know what to do with it, often they will pay that out to you as a dividend. So if you own a business and it makes a lot of money and there's nothing else you want to do with that money within your business, you're probably going to return that to yourself as an owner in the form of cash. And that's exactly what these companies are doing as well. So dividend information is really easy to find on different companies. You can look up on Yahoo Finance is probably the most common tool I use. And you can look at each individual company. So again, if you search Apple, you will see a couple of bits of dividend information. So you'll see a dividend yield. I'm not sure exactly what that number is for Apple at the moment. It's probably around 2% or maybe slightly below. Basically, that means if you buy $100 worth of shares in Apple, you will be getting about $2 worth of dividend payments over a year. So that dividend is not fixed. It can go up and down as the business becomes sort of more or less profitable over time. But that's what that means. That's the dividend yield. A couple of other things you might want to look at is something like called a payout ratio. So a payout ratio is essentially how much of the total profits of that company are being paid as a dividend. So if, for example, Apple makes $1 billion, they make a lot more than that in practice, but as an example, if Apple makes $1 billion and they pay out half of that as a dividend to all of their shareholders, so they pay out $500 million, that is a 50% payout ratio. So they're taking half of their overall profits, paying that out as a dividend, and that will come through as the payout ratio on tools like Yahoo Finance and so on. So essentially that's what shares are, that's what the stock market is. The stock market is just a big collection of all of these different companies that trade publicly, and those are the two main ways you can make money. So capital appreciation, the business grows, becomes more profitable, more valuable over time. Or number two, you get paid a dividend. So that's the very basics of stocks. Again, if you've got any questions, drop them down below. For now, let's move on to ETFs. So ETFs, or exchange traded funds, a very popular and increasingly more popular option for individual investors to easily diversify their stock market portfolios. So essentially what an exchange traded fund is it's a collection of different companies or different bonds, which we'll get into shortly, that have an overall investment goal. So the most common and most popular types of ETFs or exchange traded funds are what are called broad market index funds. And bear with me for a sec, but basically what that means is it's a collection of companies in a given stock market. So the most popular option here in New Zealand is the NZ Top 50 ETF. If you search smartshares.co.nz, you'll see all the different ETF options that Smartshares offer in New Zealand. That's probably the most popular one, is my understanding. And essentially the New Zealand Top 50 Exchange Traded Fund is a collection of the 50 biggest companies publicly traded in New Zealand. So in there you're going to find things like the A2 Milk Company, Mercury Energy, various massive companies in New Zealand, Fletcher Building, all these different things. And essentially it is an easy way to diversify across all of those companies. So instead of going out and paying fees, because you typically pay fees when you buy or sell shares, instead of paying fees to buy 50 different individual companies, shares in individual companies, you can simply go out and buy the one ETF. So you only pay a transaction fee for buying that one exchange traded fund. And within that fund, you are diversified across 50 different companies in the case of the NZ Top 50. So there's literally probably tens of thousands of different ETFs in the world that you can look up. You can invest with just about any goal you want. There's technology ETFs and large company ETFs and small company ETFs and environmentally and socially friendly ETFs and all these different things. But that is what an exchange traded fund is. A very popular option if you're just wanting to have one simple investment that is widely diversified and will likely grow over the very long term. So that's an exchange traded fund. The final thing I wanted to talk about is bonds. So often they are used in the same kind of breath as stocks. So people will talk about investing in stocks and bonds as two kind of easy sort of common options. We've talked about stocks, we've talked about shares, so let's get into bonds. So bonds fall into a category of investments called fixed interest. And essentially that means if you buy a bond, you know exactly what the return is that you're going to get. So when you buy shares in a company, the performance of that investment is going to be very dependent on how well the company does. So if the company has a bad year, those shares are probably going to have a bad year. If the company has a really good year and beats a lot of what people were expecting, those shares are probably going to perform better than expected. So there's a little bit more up and down, a little bit more uncertainty with shares most of the time. But with bonds, you know exactly what you're going to get. So when you buy a bond, it'll literally have something called a coupon, which is the percentage return that you're going to get. So that's why it's called fixed interest. You know exactly what that interest rate is going to be, whether that's 3 or 4 or 5 or 6% return. And that is why it falls into that kind of fixed interest camp. So fundamentally what a bond is you lending money to some other party, whether that's a company or the government. And those are really the two main options, either government bonds or corporate bonds. Those are really the two popular options. There are again, more complex instruments than that, but fundamentally those are the two most popular ones. And typically what happens is with a government bond, you tend to get a slightly lower coupon or a slightly lower interest rate, slightly lower return than you would with the typical corporate bond. So the reason for that is essentially the government has something called a printing press. So if they ever run out of money in terms of trying to pay you that interest rate and pay you back that money that you've lent them, which is exactly what a bond is, then they can just print more money and they're probably not going to have any issues doing that. So government bonds are often referred to, the government bond interest rate or coupon is often referred to as the risk-free rate. That's essentially the safest investment generally that there is. So that is a government bond. On the other side of things, you have corporate bonds. So Very similar concept. So you're loaning money out to this third party. That third party will pay you an interest rate for a certain period of time and then give you your money back at the end. But with a corporate bond, unlike the government bond, you are lending that money to a company. So if a company wants to take on debt and they would prefer not to go to a bank to do so, they may do a bond offering and try and obtain some cash, obtain some money to do whatever projects and acquire new assets, whatever they want to do. That's an approach they might take. So there's a little bit more risk with corporate bonds. Typically, companies can go bankrupt, and it means that if they go bankrupt, they won't be able to pay you back on your bonds. So typically, slightly more risk, but you are getting a higher return if there's no problems as a result of that. So the coupons or the interest rates will typically be higher on those corporate bonds. So there you have it. We've covered stocks, shares, ETFs, bonds, dividends. I hope that explains a lot of the basics of some of these different terms. In terms of how you get started and actually go about practically investing in these things, essentially you'll need what's called a broker. Just like when you buy a property, you need a property broker or a real estate agent to help you go through that process. It's no different with stocks, other than you typically pay much lower fees than you might when you're buying or selling a house. So you're going to need a broker. I've done a video on brokers in the past in a New Zealand context. So long story short, I use ASB Securities for any New Zealand and Australian stock purchases and ETF purchases. And I use a company called Hatch Invest for any US stock purchases or sales that I'm doing. So long story short, those are the brokers that I use. But if you want to watch a full video on why I use each of those different options, I'll put a link probably up in this corner. I get confused on the camera sometimes, maybe that corner. You should see it on the screen now. So click on that if you're interested in seeing the brokers. My only piece of advice really here would be just to take things slow. You don't have to invest all your money tomorrow or anything like that. But that's just some of the basics, and I hope you enjoyed the video. So if you did, hit like, hit subscribe, and I'll see you in the next one. Cheers.